Imagine making 40 high-stakes financial decisions in 90 minutes, where a hesitation of just like 1/10 of a second costs you a month's salary. Welcome to the main event, ladies and gentlemen. We are stepping into the arena for a very special deep dive today, and man, the energy in this building is absolutely electric.
Oh, it was buzzing in here today, just completely off the charts.
Right, because we are treating today's analysis like it is Game 7 of the Ultimate Futures Championship. We have a massive stack of scouting reports in front of us, trading manuals, behavioral finance guides, market mechanics, and we are calling the action live. We're looking at the ultimate financial gladiator sport, which is scalping. 4 quarters of grueling high-speed technical battles in the market, all coming down to a single closing bell session. Who blinks first?
Well, the stakes could not be higher, and it really comes down to pure, flawless execution today. To really understand the gravity of this Game 7, you have to understand the specific rules of the court we are playing on, because scalping is an ultra-short-term trading system.
Really short term.
Exactly. We are talking about exploiting minor price changes over a matter of seconds or, maybe minutes. This is an entirely different sport from a swing trading strategy. Swing traders are holding positions for days or weeks. They are aiming for the macro trends, but they also carry what we call overnight risk.
Oh, that dreaded overnight
Right.
rest.
If you're listening to this and you've ever held a swing trade over a weekend, you know that exact pit in your stomach on Sunday night waiting for the Asian markets to open. You have to, hold your breath through weekend news, global events, earnings reports, things that can cause the price to just gap wildly against you while the market is completely closed.
Yeah, you're totally helpless.
Exactly. But scalpers don't play that game. They are in, they take their points, and they are flat meaning out of all positions before the closing bell. They sleep with zero market risk.
I hear that, but let's be real about the trade-off here. If swing trading is like a slow burn strategic chess match where you make a move and then walk away from the board for a couple of days, scalping is essentially a 100-meter sprint where blinking costs you the entire race. The pressure must be suffocating.
Oh, it is a sprint through an active minefield. You are skimming profits from high-volume trades within a single day. And if you don't read the macro map early, if you are perfectly aware of the major structural levels before the opening bell even rings, you are going to turn the ball over before you even cross half court.
Wow.
Yeah, you have to know your environment, and you absolutely need the tools to see what the defense is setting up before they actually run the play.
Wow. Speaking of tools, if the data is moving in microseconds, you can't possibly be looking at a standard daily chart, right? A daily candlestick would just look completely frozen. You can't step onto the championship court wearing hiking boots. So what gear are these elite scalpers actually using to read the defense?
They are living on the DOM.
The DOM.
Yeah, that stands for depth of market, and it is intrinsically tied to level 2 market data. Think of a regular price chart as just the surface of the ocean. You can see the waves, but you don't really know what is causing them. The DOM is the sonar looking underneath the water.
Okay, I like that analogy.
It allows traders to see institutional volumes stacking up in real time. You actually see the bids, which are the buy orders, and the asks, the sell orders, sitting at specific price levels before they ever execute.
So it's literally having a direct tapped feed into the opposing coach's headset. You can see their plays drawn up on the clipboard before the players even step onto the floor.
It is, but here is the catch. The opposing coach knows you're listening, and they will absolutely use that against you. When you look at the DOM, you are searching for specific order flow signals. You want to see absorption, which is when massive buy orders sit at a certain level and just eat up all the incoming sell orders, refusing to let the price drop. But you have to really watch out for spoofing.
Wait, hold the phone. Walk us through the mechanics of that. How exactly does a spoofing algorithm trick the market?
Okay, so imagine you are looking at the DOM, and suddenly you see 5,000 sell orders flash at $100. That is a massive wall of supply. Retail traders see that and panic, assuming an institution is about to dump a huge position and crash the price.
Right, so they scramble to get out.
Exactly. So the retail traders start frantically selling their own positions at $99, just trying to get out early. But the institution that placed the 5,000 fake sell orders instantly cancels them before they execute and simultaneously places real buy orders at $99 to scoop up all that cheap, panic-driven liquidity.
That's brutal.
That is the how of spoofing. They flash a fake threat to force you to sell them your assets at a massive discount, Or they use iceberg orders where they want to buy 10,000 shares, but they use an algorithm to break it up into tiny chunks of 100 shares so the sonar doesn't pick up the massive submarine moving through the water.
Man, wait. If the institutions have supercomputers and they're actively deploying fake-out plays to trick the market, aren't you, the listener, the retail trader, at a massive disadvantage? Isn't this game totally rigged against the human scalper? How does a human actually survive this?
It is an asymmetrical battlefield, without question. That is precisely why understanding the market mechanics is non-negotiable. If you don't know how to read the tape and spot the spoof, you literally become the liquidity for someone else's winning trade. And it is also why your execution speed has to be flawless. In this game, we have a concept called slippage.
Slippage?
Yeah, slippage is the difference between the price you expected to get when you clicked your mouse and the price you actually got filled at because the market moved while your order was traveling to the exchange.
Got it. So if I see a setup and hit buy 5100, but it actually fills at 5100.5, that half point is the slippage.
You got it. Now, for a swing trader looking to make 100 points over a week, a half point of slippage is totally irrelevant. But for a scalper taking 40 trades a day aiming for just 2 points a trade, a half-point slip across a couple of hundred trades over a month will literally erase a profitable strategy.
Wow, that's razor thin.
It is. That is why direct market access, or DMA, and ultra-low latency setups are completely required. You bypass the retail broker middleman and send your orders directly to the exchange.
So you need the absolute fastest shoes on the court and a visual map to match, which means zooming all the way in on the charts.
Way in. Scalpers are operating on the 1-minute chart, the 5-minute chart, or even tick charts. A tick chart doesn't measure time at all. It prints a new candle only after a certain number of transactions have occurred.
Oh, interesting.
Yeah, so if the market is slow, a single tick candle might take 5 minutes to form. But right at the opening bell when the volume is exploding, a tick chart might print 20 candles in 10 seconds, giving you a pure, unfiltered look at transaction speed, while a time-based chart just shows one blurry 1-minute candle.
That is incredible. All right, the tools are set, the gear is locked, the latency is 0. The referee has the whistle in his mouth, and there's the opening bell. We are transitioning from theory to live action. The first quarter is underway. Immediately, the bears come out pressing. They're throwing a full court trap right out of the gate. Look at the selling pressure hammering the ask, driving the price down 5, 10, 15 points. It's violent.
It's aggressive, yeah. But notice how the veteran bulls, the professional buyers, are just sitting back and letting the clock run. What we are watching here is the setup for the ORB, the opening range breakout strategy.
Okay, break that down for us.
In the first 15 minutes of the market open, you have all the overnight orders executing, you have the reactionary algorithmic trading, you have global news being priced in simultaneously. It is pure chaos.
So they are willingly giving up early ground just to see where the opposing defense sets up. That takes nerves of steel when the tape is literally flashing red in your face.
It absolutely does, but they are letting the market exhaust its initial adrenaline and define the session's definitive high and the baseline support. If you're trading this, you have to remember you cannot win the championship in the first 2 minutes of the game, but you can absolutely lose it by getting caught in a volatile fakeout.
Right, you get chopped up.
Exactly. The initial chaos is just noise. The defense is drawing a line in the sand, establishing the boundaries of the court. The smart scalper is just sitting on the bench with a clipboard, marking exactly where those structural walls are being built.
Okay, the buzzer sounds for the end of the first quarter. We have our boundaries. The high is set at 5,120. The baseline low is locked at 5,100. We move into the second half of the session. Now that the court is mapped out, the offense is going to run a designed play at a critical structural level. Let's paint the picture for the listener at home. The price bars on the chart are descending rapidly toward a blue shaded rectangle at the bottom of our screen. This is the demand zone. The bears are pounding the rock inside, driving hard, testing that baseline. They are trying to breach the low of the opening range.
They are driving to the paint, but look at the volume indicator at the bottom of the screen. The price is dropping, but the transactional volume is completely drying up. It is fading to almost nothing.
Like they're running out of gas.
Precisely. It's like a fast break where the offense is sprinting for a layup, but they suddenly realize nobody else on their team is running down the court with them. The momentum is totally empty. They are exhausting their capital.
Wait, hold on. Rebound bulls. The tape stops dead at the demand zone. An absolute monster of a green bar just printed, completely swallowing the previous red candle. That is a classic bullish engulfing setup. The buyers just physically overwhelmed the sellers on the tape. A massive rejection at the rim.
Oh, what a beautiful structural play. To really understand the mechanics of why that green candle is so massive, we have to look at what our sources call sponsored candles or institutional footprints.
Okay, footprint.
Yeah, that demand zone they just bounced off of. It isn't just a random line. Demand zones are historical price floors where, in the past, buying pressure absolutely crushed the available supply, causing a sharp rally. The institutions remember these zones, and they use them to lay traps.
So how does the trap actually spring? Like, who is sponsoring that massive green engulfing candle?
The smart money institutions are, and they fund it using retail panic. Right below that demand zone baseline of 5,100, thousands of retail traders had placed their stop-loss orders. The retail crowd thought the market was going to keep dropping, so they were betting against it going short.
So they put their safety nets just below the line.
Exactly. They told their brokers, hey, if the price drops to 5,098, buy me out of this short position immediately to stop my losses.
Ah, I see the play. The institutions know those stop losses are sitting right there like sitting ducks.
They see the liquidity. The smart money temporarily drives the price down just enough, down to 5,098, to trigger all those retail stop-loss buy orders. Remember, to buy a massive position without skyrocketing the price against yourself, you need an equal amount of people forced to sell to you, or in this case, forced into market buy orders covering their shorts.
Right.
So the institutions sweep the liquidity. They absorb all that automated retail panic, accumulate a massive long position at a steep discount, and then initiate a lightning fast break in the other direction.
They swept the leg. A classic stop hunt to fuel their own offensive drive.
You nailed it. This creates a market structure known as drop base rally. They dropped the price into the base to accumulate and rallied hard off the liquidity they just stole. The momentum has completely shifted.
It's an offensive clinic. We are heading into the fourth quarter now. The momentum is swung, the crowd is on their feet, but a great setup means absolutely nothing without flawless execution before the final buzzer. The buy order trigger is hit. Entry confirmed at 5,105. And look at this, the coaching staff has drawn up a flawless risk management play. They are locking their stop loss safely behind that structural floor they just bounced off of.
And that is the defining difference between a gambler and a professional. They place that stop loss just outside the demand zone, giving the trade room to breathe, but strictly cutting the risk if the thesis is wrong. They took this shot because it's a high probability zone based on points of confluence. You never take a shot based on just one indicator.
Right, confluence means multiple distinct signals all agreeing at the exact same time. The structural bounce off the demand zone was point 1. What are they looking at for point 2?
Point 2 is the RSI, the Relative Strength Index. It measures the speed and change of price movements. Right at the bottom of that drop, the RSI was showing a bullish divergence.
Bullish divergence.
Yeah, this means while the actual price on the chart was making a lower low, the RSI indicator line was starting to make a higher low. Visually, the price is pointing down, but the momentum indicator is pointing up. It tells the scalper that the underlying selling pressure is secretly exhausted, even though the price is still dropping.
Wow. And point 3, the cherry on top of the confluence sundae.
The price just crossed back above the VWAP, the volume-weighted average price. VWAP is the holy grail for intraday institutional algorithms. Unlike a simple moving average that just averages the closing prices, VWAP factors in how much volume was traded at each price.
So it's way more accurate.
It represents the true, undeniable average cost of the asset for the day. When the price crosses up and over the VWAP line, it means the buyers have definitively taken control of the daily trend. You have the wind at your back. This is point of confluence basketball.
The breakout is live. The green candles are sprinting up the floor, 1 bar, 2 bars, slicing through the moving averages. But here is my question for you. When a scalper is riding a momentum wave like this, do they just close their eyes, hold on, and go for the dramatic game-winning buzzer beater at the absolute top of the chart?
Oh, absolutely not. That is the fastest way back to the minor leagues. You take the guaranteed layup because it funds the rest of the game. Our sources refer to this highly effective strategy as staling out, or creating a free trade. As those green candles are sprinting up the floor, the professional's already taking chips off the table in stages.
Walk us through the math of a free trade. How does the scalper actually execute that on the run?
Let's say you bought 10 contracts down at the demand zone. As the price surges upward, it hits your first logical target, maybe a minor resistance level halfway up the court. You don't get greedy. You immediately sell 5 of those contracts. You take 50% of your profit and lock it in the bank.
Okay, secured the bag.
Exactly. And simultaneously, you go into your system and move your stop loss on the remaining 5 contracts up to your original break-even entry price.
Oh, that is brilliant. You have completely neutralized the downside.
You've created a mathematically risk-free scenario. If the market suddenly reverses and crashes back down, the worst that happens to those remaining 5 contracts is they get stopped out at your entry price. Zero profit, zero loss on the back half. But you already banked the cash on the first 5. It drastically lowers the immense psychological stress of the trade.
Because you aren't staring at every single tick of the chart with your heart in your throat anymore. You can let the remaining part of your position, stay in the game to catch the big continuation move without fear.
Pros trade positions they scale in and scale out. Amateurs trade lot sizes, going all in or all out in one emotional, heart-pounding click.
And the final buzzer sounds. The runner hits the final profit target at the top of the range. The crowd goes absolutely wild. What a phenomenal execution of market mechanics. From the opening range breakout, down to the demand zone trap, and up to the VWAP for the final scale-out.
Truly a textbook game.
But as the confetti falls and we step back to look at the season as a whole, we have to ask the tough question. What is the real human cost of playing this game at this level?
It's the question every aspiring scalper has to face. Because sure, the adrenaline rush is incredible, but the reality is that scalping extracts a severe physiological and cognitive cost. We're talking about intense decision fatigue. In a typical session, a scalper might make 30 to 40 high-stakes decisions in 90 minutes.
Just evaluating the DOM, checking the RSI for divergence, verifying the VWAP, calculating the scale-out math, doing that 40 times before lunch.
Flawlessly. Every single time. Our sources from behavioral finance highlight the biology of this. Every time you analyze that much data and make a risk-based choice, you deplete your prefrontal cortex. You are burning through cognitive reserves and experiencing massive dopamine spikes and crashes with every fluctuating tick.
Man, that sounds exhausting.
It is. If your 10th decision of the morning is noticeably worse than your first decision because your brain is literally out of fuel, this fast-paced game will punish you relentlessly.
So it's not just a matter of having a good playbook. You are actively fighting your own biology.
Scalping isn't just a question of whether your strategy is mathematically profitable. It is a question of whether your mind can sustain the brutal pace without emotional degradation. This is where tilt comes in.
Tilt like in pinball.
Yeah,
Yeah.
exactly. One tilted, revenge-driven trade after a frustrating stop-out can wipe out 2 weeks of disciplined one-tick profits. The best scalpers have hard daily limits, like 3 trades, win or lose, and they walk away from the screens to protect their mental capital.
It's the ultimate test of endurance disguised as a sprint. Which leaves us with one final lingering thought to ponder as we close out this championship deep dive. In a game defined by microseconds, level 2 DOM data, and algorithmic order flow, are human scalpers eventually going to be entirely priced out by high-frequency supercomputers? When the opposing team is an artificial intelligence that operates in nanoseconds, feels no emotion, never tilts, and never ever suffers from decision fatigue, how long can human intuition keep winning Game 7?
That is the ultimate matchup of the future right there. The machines definitely have the speed, but humans still program the algorithms. Whether intuition and structural awareness can continue to outmaneuver brute computational force is something every trader will have to discover for themselves.
Definitely something to chew on as you study the tapes. Thanks for stepping into the arena with us today. Keep your stops tight, watch the tape, and we'll catch you on the next deep dive.